So we now move into Chapter 18, Chargeable Gains for Companies, Part 1. Now, there's some good news and some tricky news. I didn't want to say bad news. The good news we'll start off with, really, chargeable gains for companies, as we'll see. It's very, very similar to gains or CGT for individuals in terms of the way that it works, i.e., a three-liner, proceeds less cost equals gains. But there are one or two key differences that I will point out to you, several of them in this particular video. So in essence, in terms of a pro forma, how do we lay out CGT, or indeed, my apologies, chargeable gains for individuals? As you can see from this cut and paste job, this is not dissimilar to what we've seen within CGT. The computation of a chargeable gain for companies. Here we see the sale consideration, or the proceeds, incidental costs of sale, net consideration, and then these areas of allowable expenditure. So broadly speaking, it works in the same way. Now, note, this is in effect, isn't it, our three-liner. This is proceeds less cost equals gain. But you'll see reference here to unindexed gain. So there you have it. Here's the first main and most important difference. The idea that for companies, there's an additional cost called indexation allowance. Now you'll be familiar with the RPI and inflation. All this does is really uplift the original cost, and indeed it can uplift enhancement expenditure by inflation. So we're talking about indexing up, and these figures for indexation will be given to you. So in effect, in terms of this pro forma, nothing to worry about in terms of what we don't know or what we learned from CGT. The only thing to be careful about is indexation. Now there's a couple of little twists and turns and tricks in relation to indexation allowance, but at the end of the day, indexation allowance is just another cost. You know, you could have put it here. They'd like to keep it separate. Okay, there's no massive reason for that, but they wanted to show it separately so that it sticks out, so that you remember. Now, the examiner is going to test this in the exam, not just obviously the idea of companies having chargeable gains. He's going to test this area. We need to be savvy with indexation, how it works. And there's a couple of rules, as I just mentioned, that are specific to IA that we need to remember and learn. Now, details. It provides relief for the effect of inflation on chargeable gains. So in effect, it says, okay, you bought it years and years and years ago. Okay, well, here's some relief. Outside of that, here's the next trick, and students ignore this. It is frozen. In other words, after December 2017, there's no IA, so there's no further uplift. That's it, end of story, done. So we'll be looking in the exam for this date when you're given a series of indexation factors, because that's the one that's going to be relevant, not any one after that date, okay? More of that as we walk through questions, okay? So outside of that, what about capital losses? We know that for individuals, capital losses come in two forms, don't they? Current year losses and brought forward. Well, broadly speaking, it's the same for companies. So how do we deal with capital losses for companies? Well, pretty straightforward. Capital losses in the current year are set off against current year gains and then carried forward against future chargeable gains, okay? What we don't do with capital losses is offset them against other income, you know, in this year, in the current year, like property, trading, etc. So, key point. You're a company. You make a capital loss in the year of 10,000. What do you do with it? Well, offset it against any gains, okay? Okay, well, I don't have any gains, or I've offset, but I've still got 5,000 left. What do? Carry it forward against future chargeable gains, okay? So, not overly complex at all, okay? So that's part one in relation to this particular chapter. I hope that you found that helpful. It does get a little bit more complicated, my apologies, but not overly so. Thanks for listening.